Hey there, this is Jacob Wood with Douglas Elliman Real Estate, and I have for you here the Q1 2024 Manhattan Market Report from Douglas Elliman and Miller Samuel. Now, the first thing we notice looking at this report is that all price metrics, average closing price, price per square foot, and median closing price are down, both year over year and for the quarter. Now, in 10 years of analyzing these quarterly reports, this is the first time I recall all price metrics being down versus both the previous quarter and year over year. That didn't happen in the stagnant market of 2017. That didn't happen during COVID. Even more curiously, this contradicts directly with the feelings on the ground of most agents and buyers that attendance has come back, that offers have come back, that the market has come back. So what gives? We see that average closing price and price per square foot are both down similarly. So this isn't a case of buyers simply gravitating towards smaller homes while prices remain unchanged. We also see that the luxury submarket outperformed the market as a whole last quarter. So this is also not a case of a few high-priced outliers in Q4 or early 2023 artificially inflating those averages. When we look at co-ops, we see that co-op market performance last quarter was actually quite good, the best it's been in a long time. That leaves condos. Condo pricing is down 7 or 8% for the year, but market-wide pricing is down 5 or 6%, almost as much. So how can a 7 or 8% price correction in 1/3 of the market cause market-wide averages to come down almost as much? Well, when we look more closely, we see a 20% contraction in sales activity for condos. That's dramatic. We also know that the average closing price of a condo is over twice as high as that of a co-op. So you take away 20% of the higher priced inventory without prices even doing much, that's going to drop the market-wide pricing averages. But why was there a 20% contraction in sales activity for condos when co-ops performed so well? It has to do with the likely financial picture of the average buyer needing a mortgage in both inventory types. In co-ops, you can only borrow 80% of the purchase price at most, and you need additional funds left over post-closing anyway. In condos, you can borrow 90% of the purchase price, and the condo doesn't care if you spend your last dollar doing it. So the average buyer needing a mortgage in a condo is on less sure financial footing than the average buyer looking to borrow in a co-op. And so as interest rates have come down 10 basis points off of their October highs, that has been sufficient for the average co-op buyer looking to borrow to get back into the market. But those more rickety condo buyers who need a loan aren't back yet. So, what metric is most important for buyers to look at when gauging the overall health of the New York City market? Well, 2/3 of the purchase inventory in New York City is co-ops, and they comprise an even greater percent of the market share below that luxury threshold of 3.6 million. So if I'm a buyer in a co-op below 3.6, I want to pay attention to the median sales price in co-ops, which is up year over year. In fact, all price metrics in co-ops are up year over year. They came back in a big way last quarter. So if I'm a condo buyer below 3.6, I'm likely to find a lot of leverage. If I'm a co-op buyer below that figure, I'm likely to find a normal market. The absorption rate is 8 months, which is a market in equilibrium. Interest rates are in line with their long-term averages, and value appreciation, while prices are about 6% higher than they were last year, they are only now back in line with where they were 10 years ago, so you're still going to see a lot of value as a co-op buyer. This is Jacob Wood with Douglas Elliman Real Estate.